You don't know which supply will respect, but it doesn't matter, and you will find out after this video because there is a trick to it. We're going to start simple so anyone can understand, but it soon gets very complex, so make sure to pay close attention. So the first thing we should do is to do a quick analysis of what the market has done recently. For example, in the gold market, on the 4-hour time frame, we have this upwards move. That is followed by a small downside pullback, which shortly after starts rallying again to the upside. So this is a simple rally, base rally type of movement, also named as initiation, consolidation, and continuation. But the important factor is that the rally has broken up the previous high, validating a bullish break of structure right here, and eventually the rally has to end, so the market has more liquidity to pull. And that's seen with a pullback to the downside, but again, shortly lived, because soon after the market started rallying again. And one more time, the rally breaks above the last highs, forming a bullish break of structure. Now it's the important factor. If the market would have kept this momentum, we should have seen a base, represented by a small downside pullback to take out more liquidity, then a continuation in form of a rally to the upside, to eventually break into the highs, in such a way to keep forming the bullish break of structure. But this time, that did not happen. And instead of just pulling back, this time, the market gained very large bearish pressure, which eventually moved down to break the previous lows. A break of previous swing lows during an uptrend is a bearish market structure shift. It signals for the first time that this market might have reversed into a downtrend by not respecting the formations of higher lows anymore, and instead it formed a lower low. The expectations would be for the market to then form lower highs and lower lows. So the way to capitalize these types of moves is buying the higher lows as pullbacks on uptrends, and selling into new highs when the market forms the break of structure. And eventually, this won't respect anymore, and we'll take a loss if we keep doing it, caused by a break of the lows reversing the trend into a downtrend. But then, the market gives us the opportunity to do the exact opposite, essentially selling on the lower highs as pullbacks, and buying back with the take profit on lower lows, basically when the market forms the bearish break of structure. So in order to do that, we need to check for a selling entry model on the chart, and specifically a selling entry because we're anticipating that the market has reversed into a downtrend. The simplest, clear, and one that works well is a supply. And here it's actually the only important selling entry model that we're seeing on this recent price action. The supply being the last upwards candle right before the market started to gain bearish momentum. This being a high time frame supply zone. The simplest form of setup planning on this model is to sell short on the bottom of the supply, basically right when the market hits it, with the stop loss above the supply, because the market has pretty low chances that it will continue into higher highs, since we've had the market structure shift on a high time frame. Keep in mind these shifts can also be traps sometimes. The higher the time frame they're seen, the higher chances that they will respect, and the lower time frame, the lower chances of them respecting. And take profit is usually placed below the last swing lows, basically expecting a bearish break of structure below the lows. You can also target even lower levels. It all depends on your risk tolerance. And here it validated the first break of structure before moving into the supply, but eventually it did move to fill the supply. So now the sell short position is opened. At the same time, we can now target the next bearish break of structure. Since the first one has already worked out, we look for the next one to validate, which should be on the last low, around here, allowing a 2.5 risk-reward ratio. Notice the lower highs and lower lows. It's a good sign that it's holding this bearish continuation to eventually close with a win. Now this might continue to the downside, forming lower highs and lower lows, up until the market could bounce up from a high time frame demand on the left. For example, this is the first important demand where the market could bounce from, at least in the short term. This is the S&P 500 on the 1-hour chart. From the first sight, we see a couple formations of highs, lows, higher highs, higher lows, higher highs. So this was a simple and clear upwards trend. Then the market started pulling back down on the internal levels, increasing its bearish pressure by now forming internal lower highs and internal lower lows. The internal lower lows eventually break down below the last swing higher low, and that forms a swing lower low. So that is a bearish market structure shift on the swing levels. So before, the market was forming higher highs, continued with bullish breaks of structure, But later the market reversed into a downtrend on the swing levels. On downtrend, each low gets broken, and after it gets broken, it forms the bearish break of structure, which just indicates that the trend that has led to that point is more likely to continue. Basically the downtrend to continue. But as I said before, after a significant break on the swing levels, we usually expect a pullback, and a pullback on a high time frame downtrend is a low time frame uptrend. Uptrend that is there just to fill a bearish entry structure and basically to rebalance its liquidity. So later, it can resume the high time frame downtrend into forming swing lower lows. So the key area for traders is the swing high. That is the optimal level where smart traders are looking for an opportunity to sell short the market. But the question is, where exactly does that swing high will end? And from what entry structure will it reject to the downside? That's the hardest questions, because if we find a solution, we can pretty much snipe entry setups. So if we check all the entry models in here, we have here an extreme swing supply on the external levels. Slightly lower, there is an external imbalance. Now if we check even lower, there's an internal supply here, and also an internal imbalance below. So there's 4 entry models just on this time frame. Which one should we trade? That's the question. Based on common sense, the safest one is highest one possible, that is the swing supply. But let's see how other zones could be traded. We're starting from the bottom, for example, this internal imbalance. Usually when we have an imbalance, but also a supply above the imbalance on the same time frame, then the supply takes priority, and the imbalance is just an extra validation for the attached supply. So this zone is eliminated or taken as invalid. Now the one from above is an internal supply. By internal we mean that is not found on the swing levels, but is just from a lower high that is followed from the constant repetition of formations in the downtrend. Let me show you. So this is a downtrend. This is the swing high. This is the swing low. This is an internal lower high. This is an internal lower low. The swing supply is here. The internal supplies are here. The difference is that internal supplies can be properly traded if we zoom into a lower time frame, so the risk-reward ratio is worth taking. Because let's say we would sell short on this internal supply, but this move is just way too small before the market pulls back up again, and maybe even breaks up above. So to avoid this on internal supplies, we zoom into a lower time frame where we execute the setup there, taking profits before the market is starting to push back up again. And the swing supply zones, you probably already know about them. On these extreme supplies, our profit target goals is often below the swing lows, in order to form swing lower lows since we're in a downtrend, and we basically just trade with the high time frame trend. So now coming back into the chart. So we have this internal supply. If it would respect, the market would move similar to this kind of move. Pushing into the imbalance, then a small rejection happens. This small rejection can be traded if we zoom into a lower time frame, but with a tighter take profit area, because the market moves towards liquidity, and supply zones have more resting liquidity than imbalances. This leading to the market filling the imbalance, rejecting for a while, giving the impression that it will continue to move to the downside, but then continuing moving towards the supply. Moment where the supply fills, and we can look for sell short setups on the supply. And because this is an internal supply, we do not target the swing lows, but we assume that the market might go higher to fill the other zones from above. So best case scenario, we might expect a small pullback or rejection from the internal supply. Then a continuation to probably fill the zones from above, and the mistake traders make is they trade from an internal supply, and they target the swing levels. And this is what often happens. The market first moves towards their take profit, but because they targeted a swing level, the market often does not move there internally, and it moves straight back into their entry and eventually stopping them out. So as a quick and short summary of the internal supplies, if it respects, the market likely will reject back down and give you an opportunity for a sell short setup, but only by zooming into a lower time frame. So we can quickly take profit before the market eventually continues to move towards the levels that have more resting liquidity, which are often the external levels on the higher time frames. The first one from above being an imbalance. And if this imbalance would respect, you can actually plan a setup from here, because the market might have some higher bearish pressure to push the market towards the downside, but imbalances rarely break swing levels. So expect from external or swing imbalances to respect, and for the market to move down for a while, but then it moves back to the upside. Why? Because it has a supply attached right above. and swing supply zones are more liquid than swing imbalances. And if you would have kept your take profit below the swing lows, there would be pretty high chance that it might not get hit, and instead, the market moving towards liquidity like a magnet, stopping you out eventually to fill the swing supply. Now let's see the price action. So far the price has hit the internal imbalance and rejected back down, but then it has broken into new highs after the rejection. So it's similar to what I said, that the internal levels can be traded only if you zoom into lower time frames to make sure you find a risk-reward worth taking, in a way to avoid losing the trade even if you are wrong on the higher time frame moves. So we're forming higher highs and higher lows. The recent high also broke the internal supply, invalidating it. And the next candle is a massive bearish that broke down below the swing lows. Now here, we actually missed this setup, but that's not a huge problem, especially that we did not plan a setup yet. But all we did is market analysis. And what happened right now is extremely important, because we have confirmation that this market is holding a downtrend by forming a bearish break of structure. This move itself formed a swing supply right here, but we need more price data to validate it. So now let's see what happens next. The supply also has an imbalance. However, the market looks so bearish that it probably won't come back up to fill these zones soon. So after a massive downwards move, we finally start to see more bullish candles. Now here, pay close attention to the price action. We have an upwards move, a high, then a pullback, this potentially being a higher low. We have two scenarios. The scenario of the reversal into an uptrend. In that case, the market will likely break above the highs and form a higher high. Then we look for a demand or an imbalance to take a buy-long position. And we have the second scenario, where the market would form a lower high, then continue the downtrend by breaking down below the lows. In this case, we will look for a supply or an imbalance to sell short. And the first scenario played out, with a massive bullish candle printing. These very large candles validate imbalances. For example, we see this candle here that tried to push down, but it has failed to do so, and instead it instantly moved back up. This is an imbalance. And keep in mind, the only scenario when imbalances take priority over supply or demand zones are when the candle that formed the imbalance is much larger than previous ones. So let's try a buy-long position from this imbalance. Stop loss below the imbalance, and take profit above the highs. Why above there? Since the market has reversed from a downtrend into an uptrend, by forming higher highs and higher lows. The next expectations are after forming a higher low, is to form a higher high. So that would mean that we might get a bullish break of structure above these highs, that being the first optimal take profit level. And finally, after so much analysis and patience, a great setup. Now let's watch another market, this time on an FX pair. So here we've had a huge upwards move, then the bullish pressure started slowing down, so at the same time the bearish pressure started increasing, slowly dragging down this market, eventually moving and breaking below the last swing lows, forming a bearish market structure shift on the high time frames. So externally, we've reversed from an initial uptrend into a downtrend, this on the high time frames, because on the low time frames a pullback to the upside is expected after basically any significant downside break. But that pullback has high chances that it will fade down to continue the downtrend. The reason is pretty simple. It's very hard to catch a reversal before it happens. So by waiting for the reversal to form and then thinking the move, it allows traders to trade with the trend, which usually more traders find greater success with. So if we're looking to take the market down, we need to look for selling entry models. So let's identify these models. Here, for example, we have a supply. Right above, we have another supply. And here another one as well. Also on the highs. Here we have the last supply. Well, now the question is, how can we know which one we'll respect? Because there are so many, and they are close to each other. One logical solution is to take the safest one, that being the last one. So this one. This keeps some safety that if this supply fills, that means that the other ones from below have failed. But then the problem is, what if the market does not move into the last supply, and instead it fills the other ones? Well, in that case, we miss a setup, which is still better than losing a trade, but if this situation is met multiple times, you can go weeks without any trades and many lost opportunities. There is another solution, and that is taking the first supply. And you might ask, isn't that one with the highest risk? And if you would simply take the trade without any more complex concepts like a top-down analysis or anything else, then you would be right. Because if we're selling this supply, with the stop loss above the supply, and take profit below the swing lows. If this supply would not respect, most of the times it does not just break right through it, but oftentimes it actually still respects for a short time period, rejecting the price down. But then what happens as an invalid supply is that after a downside rejection, it starts pushing back to the upside, eventually stopping you out. But let's see what happens first, then we can react to the price action. So far it's moving on a consolidation. Now we got a breakout on the lower time frames, pushing the price higher, and eventually filling the first supply. Alright, now we see that we've got a small rejection to the downside. It's what I've said before, that even if this supply would fail, it still first shows some kind of bearish pressure before eventually breaking the supply to the upside. But that's not always the case. The market can also respect this supply and break towards the swing lows, but I like having the worst case scenario in mind, just to keep it more safe. So as I said, the way to capitalize, even if you're wrong on the higher time frames, is to look for an opportunity on lower time frames close to the same entry structure. So for example, switching into the 5-minute time frame here, we see the price action in more depth. Initially, we've had an uptrend here, of course, being the move that has filled the high time frame supply itself. But then right after filling the supply, the market started to move slowly down, showing some signs of buyer's exhaustion and bearish pressure by forming lower highs and lower lows. From where we get a pretty large bearish candle that covers many of the previous candles. These large candles usually leave an imbalance, and here it's quite easy to observe, being the lower wick of the candle previous to the large one, connected with the upper wick of the candle next to the large one, and this entire area is called an imbalance, a bearish imbalance more specifically. We can also check for other imbalances to have a proof of concept, to have an idea if they've worked lately or not. For example, here, we have another one that got filled and rejected to the upside from it, being a small bullish imbalance. Here we have another imbalance, this time a bearish imbalance that got filled, and pretty much these are the last two that we see from those that are close to the last one. So now for the setup positioning, being a bearish imbalance, we look to sell away from this imbalance, with the stop loss above the recent highs. This is more safely considering this is a low time frame setup. The take profit is usually placed below the most recent lows. So here, we have this high. Then the next is lower than the last one. And we're basically expecting that the next high will also be lower than the last high. And that's the logic behind the placement of the entry and stop loss. This entire move can hold this downtrend action for lower than where our take profit is. For example, the first area where the market has higher chances of bouncing to the upside is this level, which is the first more important demand that we see here. And we can actually target this level. Just make sure the risk-reward is not too high. If you don't feel comfortable with this risk-reward, you can widen the stop loss above, and it will be placed right above the swing highs on this time frame, which still leads a great risk to reward, but with very calculated and logic profit and stop loss targets. And now we need patience, basically letting the market do its thing. Right here on this few couple candle formations, we see higher lows and higher highs. So it's holding this buying pressure, which is good. We want this to move up in order to fill the imbalance, which eventually does a couple minutes later. And we see a massive rejection to the downside afterwards, with the price now forming lower highs and lower lows, indicative of a downtrend. Now we pretty much just wait, it's getting close here. The bearish pressure is much higher than the bullish pressure. We just need to wait. And that was it. And actually, it went even lower, breaking below this low time frame demand. But that is because the high time frame entry models take priority over the low time frame ones. So basically we're saying that the high time frame supply was expected to hold over a low time frame demand. And this is how the price action looks like now back on the 1-hour chart where we first done the analysis. A popular setup planning, because it just works, but patience was crucial here. Some traders say this analysis is difficult, and I disagree. You can learn it pretty quick. I've linked in the description my work of learning years of trading, what works and what doesn't, with the strict necessary and nothing more. And if you like the video, make sure to leave a subscribe, and thank you for watching.